The stock market is at near all-time highs right now, and that is the most dangerous sentence you will hear all year, not because the market is about to crash tomorrow, but because the reason it hasn't crashed yet has nothing to do with the economy being healthy, and everything to do with four mechanical forces that are quietly holding the entire system together. When those four forces break, and the conditions for at least two of them breaking are being constructed right now in real time, the average investor will have no idea what hit them. I am going to show you exactly what those forces are, exactly what breaks them, and exactly what you need to do before the machine stops working. If you find this kind of analysis useful, the kind that actually explains the mechanics behind the headlines, drop a like right now. It takes 2 seconds, and it tells me to keep making content like this instead of the surface-level noise that fills most feeds. Here is the problem that nobody wants to say clearly. The stock market has not been going up because the economy is strong. It has not been going up because corporate earnings justify current valuations. It has been going up because of four specific structural forces that operate almost entirely underneath the surface of what financial media covers. Most investors have no idea these forces exist, and that ignorance has a price. Because right now, in this specific macro environment, $36 trillion in national debt, active geopolitical conflict across 3 continents, tariffs dismantling supply chains that took 50 years to build, and a Federal Reserve that has publicly admitted it does not know what to do next. In this environment, understanding why the market hasn't fallen yet is the most important financial question you can ask. Because the answer tells you exactly when it will. Before I get into the four forces, I want you to sit with one number. Since 2009, the S&P 500 has averaged approximately 14% annual returns. The long-run historical average before 2009 was closer to 7%. That gap is not evidence of a stronger economy. It is evidence of structural support that has been inflating returns above their natural level for 15 consecutive years. Most investors have built their entire financial plan around the 14% version of reality. What happens to that plan when the structural support comes off? That is the question I want you to be asking yourself for the next 20 minutes. Share this video with someone who needs to hear that framing before they find out the hard way. The first force is what professional traders call the Fed put. Let me translate that into plain language because the translation is the scary part. The Fed put is not a law, not a guarantee, not anything written down anywhere. It is a collective market belief, a shared psychological expectation that if asset prices fall hard enough, the Federal Reserve will intervene. Cut interest rates, print money, buy assets, do whatever it takes to stop the bleeding. That belief has been validated twice in the last 15 years in ways that made the lesson impossible to forget. In 2008, the Fed stepped in and prevented a complete financial system seizure. In 2020, when the pandemic shut down the global economy overnight, the Fed went to zero interest rates, printed trillions, and sent checks to every household in the country. The market fell 34% in February 2020. By August, it was at all-time highs. The message to every investor on Earth was unmistakable. We will not let this collapse. And right now, in 2026, the Fed has already cut rates twice based on inflation data that many economists describe as premature. They are currently conducting $35 billion per month in what they are calling reserve management operations. They are not calling it quantitative easing because that phrase carries political weight. But the mechanism is identical: newly created money entering the financial system and placing a floor under asset prices. Here is the kill switch on the Fed put. And I need you to understand this before we go any further, because this is where it gets genuinely dangerous. The Fed can only bail out the market when inflation is under control. The moment inflation re-accelerates, if oil prices stay elevated due to Middle East disruption, if tariffs push the cost of imported goods higher, if food prices spike due to supply chain fragmentation, the Fed's hands are tied. It cannot cut rates to prop up stocks if cutting rates means gasoline hits $5 and groceries climb another 20%. We saw this exact trap in the 1970s. The Fed chose to kill inflation even at the cost of a brutal multi-year recession. If that trap closes again, and the conditions for it are being actively constructed right now, the backstop disappears. And nobody is positioned for a market without a backstop. The second force is what I call the passive money machine, and this is arguably more structurally significant than the Fed put. In 2010, passive investing through index funds and ETFs represented roughly 19% of all invested capital in U.S. equities. Today, that number exceeds 60%. Think about what that means mechanically. Every 2 weeks, tens of millions of Americans receive a paycheck. A percentage of that paycheck automatically flows into a 401k. That 401k automatically purchases index funds. Those index funds automatically buy stocks. No analysis, no valuation check, no asking whether the market is priced rationally. It just buys, at all-time highs, during geopolitical crises, in the middle of panic. It is the most relentless, emotionless, continuous buying force ever constructed in financial market history, and it operates on autopilot every single day the market is open. Think of the market as a bathtub. Every paycheck cycle, billions of dollars pour through the passive investing faucet. When a sell-off happens, water drains out the bottom. But the faucet never stops, so even during significant declines, that constant mechanical inflow cushions the fall and compresses recovery time. That is the mechanical explanation for why every sell-off in the last decade looks like a perfect V on the chart. The money never stops arriving. But there is a mathematical concentration effect inside this force that almost nobody talks about. The S&P 500's top 7 companies, NVIDIA, Microsoft, Apple, Amazon, Alphabet, Meta, and Tesla, currently represent approximately 33% of the entire index by market cap. So when your 401k contribution buys the S&P 500 this month, roughly 33 cents of every dollar goes directly into those 7 companies. That buying pressure compounds daily. It is not earnings, not innovation, not productivity driving those valuations. It is pure mechanical index weight, and the kill switch on this force is unemployment. If a serious recession pushes unemployment from 4% to 7 or 8%, people do not just reduce their 401k contributions. They stop contributing entirely, and then they start withdrawing, selling assets to cover rent, medical bills, survival. The faucet slows, the drain widens, and simultaneously the baby boomer generation, the largest cohort of investors in American history, is actively transitioning from accumulation to distribution. They are flipping from buyers to sellers. That generational flow reversal has never been absorbed at this scale before. The third force is algorithmic trading, and the scale of it changes how you should think about every market movement you see. Estimates vary, but systematic trend-following funds and algorithmic trading systems now account for a significant majority of daily market volume. These systems do not read earnings reports. They do not have geopolitical opinions. They do not care about valuations. They follow price momentum with mathematical precision. Price trends up, they buy. Price trends down, they sell. When a sell-off begins, these systems amplify selling pressure. But here is the counterintuitive piece that most coverage misses. The selling exhausts itself mechanically. These systems can only liquidate the positions they hold. Once they have sold, the selling stops. The market stabilizes. The systems detect stabilization as a buy signal. One system starts buying. Another detects the buying momentum. A third adds to it. What looks from the outside like investor confidence returning is actually automated code executing a function. This is why sharp, sudden sell-offs, the kind that feel like the beginning of a real collapse, frequently reverse within days. It is not sentiment, it is not confidence, it is the algorithmic cycle completing itself. The fourth force is options market maker hedging, and I want to explain this in the clearest possible terms, because this is the piece most investors never understand and it costs them real money. Options market makers are the institutions that sit on the other side of options trades. They profit from the spread between what they pay and what they charge, multiplied across millions of transactions. Because they are not making directional bets, they hedge their exposure constantly. Here is the critical mechanism. When the stock market drops sharply, options market makers are mathematically required to buy stocks to maintain their hedge ratios. This is not discretionary. It is automated. They become forced buyers during sell-offs. That mechanical buying directly dampens the severity of market declines and compresses volatility spikes. It is a shock absorber built directly into the derivatives market structure, and it activates automatically every time the market tries to fall hard and fast. These four forces together, the Fed put, passive flows, algorithmic trading, and options market maker hedging, have created a structural floor under this market that has held for 15 years, but none of them are permanent. None of them are unbreakable. And right now, the conditions for at least two of them breaking simultaneously are more visible than at any point in the last decade. Here is where the analysis becomes personal. And I want you to stay with me for this part, because this is the piece that actually changes how you manage money. The first collapse scenario is the debt spiral. The United States is carrying $36 trillion national debt, and that number grows by approximately $2 trillion per year at current trajectory. The bond market, which is larger and more powerful than the stock market, is the mechanism through which this becomes a crisis. When bond investors begin demanding higher yields to compensate for the risk of holding U.S. government debt, interest rates rise. At 6 or 7% yields on Treasury bonds, suddenly risk-free government debt pays more than most equities return in an average year. Capital rotates out of stocks into bonds at scale. Equity valuations compress. And the government, already carrying historic debt levels, now pays higher interest on that debt, which requires more borrowing, which pushes more bonds into the market, which pushes yields higher. That feedback loop is not theoretical. It is the mechanism by which every sovereign debt crisis in modern history has developed. The second scenario is the inflation trap. If oil stays elevated due to sustained Middle East disruption, if tariffs continue embedding cost increases across supply chains, the Fed is caught between two options with no good answer: cut rates to support the economy and pour fuel on an inflation fire, raise rates to kill inflation, and trigger the recession that breaks the passive money machine. That is stagflation, and the conditions for it are being constructed in real time. The third scenario is the AI repricing. The top 7 stocks in the S&P 500, representing a third of the entire index, carry valuations that are pricing in transformative AI productivity gains, arriving within a compressed time frame. Look at every major technology cycle in the last century, and the pattern is identical without exception. Initial projections overshoot reality. There is always a period, sometimes years long, where the gap between expected and actual payoff closes violently, and the stocks priced for the original projection absorb the full correction. The final technology always exceeds even optimistic expectations. But the path between here and there is where fortunes are lost. A visible AI development plateau, a public moment where current limitations become undeniable, would trigger a repricing across those 7 stocks that pulls the entire index with it. And then there is the scenario nobody has a model for: a major cyber attack on financial infrastructure. A single institution with catastrophic leverage unwinding in a way that creates cascading counterparty failures. A geopolitical escalation that the market cannot price. History's most expensive financial crises were unanimously described as impossible by expert consensus until the day they were not. Now here is the honest math that changes how you think about your own portfolio. If you are an average American investor who has been in the market for the last 15 years, your returns have been partially driven by structural support that has no precedent in financial history and will not persist indefinitely. That is not an insult. It is a statement about base rates. The distinction matters because your mental model of how markets behave, how far they fall, how long they stay down, how quickly they recover, is calibrated to a structurally supported period that is not representative of normal market behavior. A 40% market decline, which is what a genuine 2008-style bear market looks like, applied to a $250,000 portfolio removes $100,000 of wealth. A 50% decline, which is what the Nasdaq experienced in the dot-com bust, removes $125,000. And then consider the recovery math. To recover from a 50% loss, you do not need a 50% gain. You need a 100% gain. Because if your portfolio drops from $250,000 to $125,000, it needs to double just to reach zero. At a historical average annual return of 7%, that takes approximately 10 years. A decade of your financial life spent returning to where you started. The question is not whether a decline like that is possible. The question is whether your current portfolio construction assumes it cannot happen, and whether that assumption is based on analysis or simply on the fact that it has not happened recently. There are two rational responses to this environment. The first is staying invested with clear signals. If the four forces hold, and there are legitimate reasons to believe they continue holding in the near to medium term, you want market exposure. But intelligent exposure means you are not passively concentrated in the same 7 stocks that represent a third of the index. It means you are watching 3 specific signals: Federal Reserve language around inflation versus growth, Treasury yield movements in the 5 to 10-year range, and employment data, because employment is the trigger that breaks the passive money machine. When those 3 signals move in a coordinated negative direction, you are not reacting to headlines. You are reading the structural indicators. The second response is building a real hedge before the next crisis begins. Not during it, because during it is too late. Hard assets, physical precious metals, commodity-linked equities, energy infrastructure, behave differently from equities during inflationary shocks and currency debasement events. They are not a replacement for equity exposure. They are a counterbalance. If your portfolio has zero allocation to any of these, what you have is not a diversified portfolio. It is an equity portfolio with the appearance of diversification. Understanding how to use put options as portfolio insurance is not advanced investing. In a structurally complex environment like this one, it is basic risk management. A small defined cost that pays out significantly in a tail risk event is one of the most asymmetric rational decisions you can make when the structural supports you now understand are visibly under simultaneous stress. The real threat in this environment is not the next market crash. The real threat is the assumption that because the market has behaved a certain way for 15 consecutive years, it will continue to do so indefinitely. Every financial crisis in modern history was preceded by exactly that consensus. The belief that the old rules no longer applied, that something new and permanent had been discovered. Nothing new had been discovered. A more sophisticated version of the same structural fragility had been built. And when it resolved faster and harder than almost anyone anticipated. You now understand the 4 forces holding this market off the floor, which means you also understand exactly what needs to break for the floor to disappear. Watch the Fed's language on inflation. Watch Treasury yields in the 5 to 10-year range. Watch oil. Watch employment data. And watch the bond market. Because when bond investors decide they have lost confidence in American fiscal trajectory, they will not announce it. The yield will simply move. And by the time most people recognize what the move means, the move will already have happened. The people who come out of the next structural shift intact will not be the ones who predicted the timing perfectly. Nobody predicts the timing. They will be the people who understood the mechanism well enough to have already prepared. If that framing is useful to you, this kind of structural mechanical analysis instead of headlines and noise, I put out daily updates on exactly this. Subscribe if you want to be in the room when the next signal fires, not because something is about to crash tomorrow, but because preparation is the only version of this that actually works.